Lecture, Efficient Diversification. In this lecture, we will introduce the definition of covariance and correlation. We will talk about the optimal allocation problem too, allocating between two risky portfolios. We'll introduce the mean variance criteria and also introduce optimal allocation 3, allocation between one risk-free and two risky assets. And finally, we'll introduce the minimal variance frontier and the efficient frontier. We first start with the observation that if an economy has only two firms, firm A sells sunscreen and firm B sells umbrellas, if both A and B are expected to deliver a 10% return per year, but the standard deviation of A is 20%, standard deviation of B is 15%, and what should be the optimal investing strategy? Should we invest in firm A, invest in firm B, or a combination of firms A and B? This lecture will show you that it is better to invest in C, which is a combination of the two firms, because the strategy will allow us to maintain the expected return of 10% for the portfolio while reducing the standard deviation of the portfolio to below the lowest of the two firms, standard deviation 15%. So we'll show why that is the case throughout this lecture. Let's first define covariance. Covariance measures the co-movement of returns between two assets, say I and J. So covariance is denoted as sigma ij. It is defined as the probability weighted product of the return deviation of each asset relative to its mean returns. So when the two assets tend to move up or down together relative to their respective mean returns, the product will be positive. And so the probability weighted product will be positive, leading to a positive covariance. If instead, when asset I tends to go up relative to its mean, but asset J tends to go down relative to its mean at the same time, the products will be negative, and the probability weighted at product will be negative, leading to a negative covariance. Therefore, a positive covariance indicates the two assets tend to move up and down together, while a negative covariance suggests that the two assets tend to move up and down in the opposite direction. In Excel, you can use the function COVAR to calculate the covariance between two assets. Next, let's look at correlation. Correlation is a standardized covariance measure. You take the covariance between asset I and J, scale it by the product of the standard deviations of I and J. That arrives the correlation coefficient rho ij. Conversely, you can move from covariance to correlation coefficient. Conversely, you can move from correlation coefficient to covariance by multiply rho by sigma I and sigma j. For example, if we have two portfolios A and B having a covariance of negative 0.114, we know the standard deviation of A and standard deviation of B. What is the return correlation coefficient rho IB? According to the formula, we take the covariance between A and B scaled by the product of the two standard deviations, which gave us the correlation coefficient negative 0.99, which suggests that the two securities tend to move up and down in the opposite direction, and they have nearly perfect negative correlation coefficient. In general, correlation coefficient rho has to be between -1 to +1, with +1 indicating the two securities are perfectly correlated, and with -1 indicating the two securities are negatively correlated. When correlation coefficient is 0, it means that the two securities are not correlated. When one security moves in the up or down, it doesn't provide any indication of the movement of the other security relative to its mean. To calculate the correlation coefficient rho in Excel, you use the function CORREL. Now let's move to asset allocation problem 2, allocating between two risky assets. Recall that in our previous lecture, we introduced the asset allocation problem 1, which is allocating between one risk-free and one risky assets. Before we introduce the formula for this allocation problem, let's first look at the example to understand the definition of allocation. Suppose we have both equities and bonds in a risky portfolio P with different money invested in one of the two assets. Then omega-1, which is the allocation to equity, will be equal to the money invested with equity over the total market value of the portfolio, which gives 54%. Same thing for the bonds, which has an allocation of 0.46 or 46%. So when we have only two risky assets together, the weights omega-1 and omega-2 have to sum up to be 1. In this two risky asset portfolio, we have three rules or three equations. Here we use 1 to denote for equity and 2 to denote the bond. Rule 1 says that for any given state of the economy, the rate of return of the portfolio is a weighted average of the two returns of the assets. Rule 2 says that across all states of the economy, the expected return of the portfolio is equal to the weighted average of the two expected returns. The third rule says the variance of the risky portfolio is equal to omega-1 squared sigma 1 squared plus omega-2 squared sigma 2 squared plus 2 omega-1 omega-2 sigma 1 2. You can rewrite sigma 1 2, which is the covariance, into correlation coefficient rho 1 2 times sigma 1 and sigma 2. So this equation says that the variance of the two risky asset portfolios is determined not only by the variance of each of the two assets, but also the covariance between the two assets. It is essentially the weighted sum of the covariance-variance matrix. So with special cases here, if correlation coefficient between the two assets is 1, so we can rewrite the equation into sigma p squared equal to omega-1 sigma 1 plus omega-2 sigma 2, the whole thing squared. That implies that when we have correlation coefficient equal to 1, standard deviation of the portfolio is a weighted average of the two standard deviation, so there is no diversification effect. In contrast, when correlation coefficient is -1, sigma p squared is equal to omega-1 sigma 1 minus omega-2 sigma 2, the whole thing squared, so that sigma p is the absolute value between the weight times the sigma of each asset and take the difference between the two. In this case, we have the maximum diversification effect because the standard deviation or the risk of each asset is offsetting each other's. So let's look at this question. Which of the following is most correct concerning the two-stock portfolio? A, the portfolio should have no company-specific risk. This statement is not correct because having two stocks in the portfolio is not enough to diversify all company-specific risk. B. Portfolio standard deviation can never be a weighted average of the two stocks' standard deviations. This statement is incorrect because we just showed that for rule 3, if correlation coefficient is positive 1, portfolio standard deviation is a weighted average of the two stocks' standard deviation when there's no diversification effect. C. Portfolio return is a weighted average of the two stocks' returns. That is correct. Based on rule 1, for any state of the economy, portfolio return is always equal to the weighted average return of all assets in the portfolio. So our answer should be C. Let's look at this example, which allows us to apply the rules of the two-stock portfolio to solve this problem. So we have the equity fund and bond fund with the expected return standard deviation of each asset given. In this case, correlation coefficient between equity and bond is 0, and we have a portfolio weights allocation, which is we call 50-50. So what is the expected return and standard deviation of your portfolio? What we need to do is to simply apply rule 2 and 3 for the two-stock portfolio and to find out the answer. For the expected return, let's take a weighted average of the two expected return, 10 and 6. That gives us 8%. So we have 50-50 allocation, which is give us the average of the returns between the two. For variance, we're going to plug in the omega-1 sigma-1 square plus omega-2 sigma-2 square plus 2 times omega-1 omega-2 correlation coefficient sigma-1 sigma-2. As the correlation coefficient is 0, so the covariance term becomes 0. So we have this variance of the portfolio equal to 192.25. Please note that because we abbreviated the percentage sign to the standard deviation, 25 and 12, we should be percent. So essentially the units for the variance here is percent squared because all the standard deviations are squared. Okay, so when we take the standard deviation by taking the square root of the variance, we get 13.87, then we add back this percent because the percent square, we're taking square root to get percent. So when we combine equity and bonds with 50-50 allocation, while we are able to improve the return from bond by 2 percentage points or 1/3, our standard deviation relative to that of bond didn't increase by 1/3. It only increased slightly because of the diversification effect between equity and bond. That goes back to the example with the island economy with the sunscreen and umbrella firms that essentially we can increase the expected return or keep the expected return unchanged while substantially decrease standard deviation. In the second exercise, you are given the correlation coefficient equal to 0.5 and different portfolio allocation 25 versus 75%. So by plugging the parameters into the same two equations, we'll have 7% as the expected return for the portfolio and 13.28% as the standard deviation of the portfolio. In general, if we plot the combination of return and risk for the stocks and bonds based on different allocation, we can form this investment opportunity set. Okay, so this frontier essentially tells us the risk return combination if we change the allocation to bonds versus stocks from 100% bond all the way to 100% stock. When we're extending this line below the bonds or above the stock, we're doing the short portfolio. Here we're buying bonds but shorting stocks, and here we're shorting bonds and buying stocks. And among all these possible portfolios, based on different allocation, we have a minimal variance portfolio, which refers to the portfolio with the lowest variance in all combinations. As you can see that the investment opportunity set forms a curve that extends to the northwest corner. So this is the diversification effect. While we are able to move the return up the north, we are able to reduce the standard deviation to the left, which is the northwest corner. So the more curvature we have in the investment opportunity set, the higher the benefit of diversification in our case. So in general, if this diversification effect or the curvature of the curve is determined by the correlation coefficient of the two assets. When the correlation coefficient is 1, we have no diversification effect or no curvature in the investment opportunity set. So that's the straight line. When we have correlation coefficient below 1, some curvature will appear, which indicates diversification effect. The lower the roll, the more curvature we have. In the extreme case, when we have correlation coefficient roll equal to -1, we have the most extreme diversification effect, which means that with certain combinations of stock and bond, we are able to form a risk-free assets that has 0 standard deviation. So whenever we have correlation coefficient less than 1, there is diversification effect. So when do we have the maximal diversification effect? By combining securities in the portfolio. What is the correlation coefficient between the securities? As we just have shown that the maximum diversification effect comes when the two securities have a correlation coefficient -1. That's when you can possibly form a risk-free asset that diversify away all the risk. So that's C is our answer. Now let's move to mean variance criteria. When we have the investment opportunity set, we have to set a criteria to determine the optimal or the more efficient portfolio. We assume that investors are rational in the sense that they prefer higher expected return but lower risk. Therefore, in general, among the investment opportunity set, the desirable portfolio will lie in the northwest corner of that curve. Correspondingly, the mean variance criteria says that when investors choose between different portfolios, if the portfolio have the same mean expected return, investors would prefer the portfolio with lower risk. Or if the two portfolios have the same risk, investors would prefer the portfolio with higher expected return. So higher expected return dominates or lower risk dominates, and that's our mean variance criteria. With the mean variance criteria in mind, let's see which of the 3 portfolios should not be efficient. Okay, they should not be desirable by investors given the parameters. Here, the answer should be between the comparison of Y and Z. Both Y and Z have the same risk standard deviation, but Z has a higher return than Y, which means that Z would dominate Y. Z might be on the efficient frontier, but Y cannot. So therefore, we can surely rule out Y as an efficient portfolio because it's inferior to Z. In general, when we allocate between one risk-free and one risky asset, which we have shown before, and the line that connects the risk-free assets and the risky asset is called the capital allocation line. So for any possible portfolio, by combining stock and bonds, the portfolio represents one of the point on the pink curve, and we have the asset allocation, capital allocation line for that portfolio, say for A and for B. So which one is the best portfolio that investors should consider among the investment opportunity set. It is clear that the best portfolio should have the highest slope in the capital allocation line, which will turn out to be the tangency portfolio, because the tangency portfolio connects the risk-free rate and the tangent point on the curve, which gives the highest Sharpe ratio among all portfolios on the investment opportunity set. So in this case, O will be our tangency portfolio or optimal risky portfolio, and it will have the combination of return and risk as shown in the graph. How do we exactly find out the optimal risky portfolio? How do we allocate between the two risky assets in order to arrive the optimal risky portfolio? This problem has been solved mathematically by prior researchers with the formula given below. So if we want to find out the bond weight, what we need to do is to take the excess return of the bond times the variance of the stock minus the excess return of the stock times the standard deviations of the two securities and times the correlation coefficient between the two. The denominator will be the excess return of the bond times variance of the stock plus excess return of the stock times variance of the bond minus the excess return of bond plus excess return of stock times two standard deviations and correlation coefficient. So by plugging the parameters into this equation, you'll be able to solve for the weight, optimal weight on the bond. And 1 minus that optimal weight on the bond will give you the optimal weight on the stock. Alternatively, you can replace all the subscript B with S and all the S with B, then you can solve for the optimal weight on the stock directly. So those two equations essentially tell you how do you allocate your money between stock and bond in order to get the optimal risky portfolio that has the highest Sharpe ratio. Finally, let's move to asset allocation problem 3, which is allocating between one risk-free and two risky assets. We have learned allocation problem 1, allocating between one risk-free and one risky assets. We also have learned allocation problem 2, the allocation between two risky assets. How do we combine those two to get the allocation between three assets? Okay, so here are the steps. Step 1, we focus on the two risky assets and finding the investment opportunity set of the two risky asset portfolio. Step 2, we'll form the optimal risky portfolio, use the big ugly formula for tangency portfolio. So where we will be able to combine the two risky assets into one risky asset, the portfolio O, which should have the highest Sharpe ratio and the best risk-return trade-off. Now we're left with one risky asset instead of two, because any other risky asset that's formed based on the combination of stock and bond will be dominated by the O portfolio. So step 3, we will be using allocation problem 1 to allocate optimally between the risk-free asset and the O portfolio based on the risk preference of the investor in order to form the complete portfolio. So the complete portfolio is the optimal combination of the risk-free asset and the O portfolio based on the risk preference of the investor based on the formula we introduced in earlier lecture. So the optimal allocation to the O portfolio will be equal to the available risk premium to variance ratio divided by the required risk premium to variance ratio, which is the excess return on O divided by A times the variance of O. Okay, so essentially we are splitting the allocation between three assets into allocation between every two assets in order to arrive the complete portfolio. So in the example we have been demonstrating, we'll first combine stocks and bonds based on the optimal weight in order to form the optimal risky portfolio. Then we're going to look for the complete portfolio among the investment opportunity set of the O portfolio, which is the capital allocation line for the O portfolio, and to find optimal allocation to form our C portfolio. So the C portfolio has the optimal allocation between the risk-free asset and O portfolio based on the risk aversion of the investor. Okay, so that completes our three-step allocation to form the complete portfolio. In general, we can use the steps to form the optimal risky portfolio with multiple risky assets. If we have more than 2 risky assets, in order to arrive the optimal risky portfolio by combining all of them, we can do the optimal allocation for every pair of assets, then eventually get rid of those dominated assets and leave the optimal combinations and continue to optimize between those assets in order to get one single optimal risky portfolio. Eventually, in the next lecture, we will show that when we have n-risky assets, when you try to optimize between those risky assets, you will be able to form a minimal variance frontier. And among the minimal variance frontier, the upper portion of that curve will be so-called efficient frontier. So minimal variance frontier includes all portfolios that has the lowest risk given each level of mean returns. And the efficient frontier portfolio has also the highest return given each level of risk. Therefore, efficient frontier portfolios will dominate all other individual assets or portfolios through the combination of those individual assets. On the efficient frontier, we will show that the tendency portfolio of the efficient frontier will be defined as the market portfolio, which is part of the CAPM, the capital asset pricing model. And the market portfolio will have the highest Sharpe ratio. And it has been shown that the market portfolio can be constructed by using the market cap weighted index of raw risky assets. So we'll continue this discussion when we move to the capital asset pricing model lecture. Lastly, so let's look at this exercise. So when do we consider a portfolio being efficient? A, if there is no other portfolio with a higher expected return. B, if there is no other portfolio with a lower risk. C, there is no other portfolio offers a higher expected return with a higher risk. Or D, there's no other portfolio offers a lower risk with the same expected return. Here, efficient portfolio or efficient frontier are defined by the mean variance criteria. A mean variance criteria refers to the fact that no other portfolio offers the lower risk with the same expected return, or no other portfolio offers the high expected return for the same level of risk. So that completes the lecture.